This is the second video in a three-part series on the money market. This lesson focuses on the factors that determine the interest rates that a financial intermediary will charge a borrower. In our next video, we will hook up the money market to our circular flow model. In the previous video, recall that we established that the money market is populated by financial intermediaries. A financial intermediary, of course, is a middleman. Now, this particular kind of middleman brings together those with a surplus of cash who want to put it to work, and those with a shortage of funds who want to buy something now rather than having to wait until they save up enough cash. The compensation that the borrower makes to the lender for this service that he values is called interest. Interest is effectively rent that the borrower pays to the lender while holding and using his money. However, it is usually very difficult for these two parties to get together without the help of a middleman. If you wanted to borrow some money, how are you going to find a person A with a surplus of cash and B who will trust you with their money? Or, as a lender, how would you find a reliable borrower? One that would A, pay you your interest when it is due, and B, pay your money back in full when the terms of the loan expire. In most cases, finding a counterparty is much easier, quicker, cheaper, less stressful, and more efficient by using the services of a middleman, a bank, a credit union, a savings and loan company, a depository institution. And as we saw in the previous video, the thing that makes the depository institution so good at being a middleman is that it keeps an inventory. The inventory of a depository institution is money. So now we are going to consider the factors that determine the interest rate that a bank or some other depository institution will charge a borrower on a loan. Every business person will tell you that the first principle in determining how to price their product would be to cover the cost of acquiring the inventory of the good. That is, the price of the product must exceed its cost. Whether that's the cost of producing it themselves or the cost of acquiring it from, say, a distributor or a wholesaler. How does a financial intermediary acquire its inventory of money? It does so by somehow motivating you to deposit it in its bank vault rather than spending it or depositing it in some other bank's vault. One way might be by bearing most or all of the costs of providing a potential depositor with checking services. Checks are often more convenient to use than cash. If a bank were to provide you with such a service at no or very low cost, that just might do it. We'll talk more about checking accounts and check clearing services when we get to Module 10 on money, banking, and monetary policy. Another way to acquire its inventory is just simply to pay the potential depositor. And this is exactly what it's doing when you open up a savings account, whether it's a passbook account, a money market account, or a certificate of deposit. How much would it take to motivate you to deposit money in a bank vault rather than spending it? Buying something is much more exciting and provides me with much more utility than letting the cash sit in a bank vault. But if the bank pays me enough, I just might think about it. But all the banks face the same dilemma. So, to make sure the saver deposits money in your bank, you've got to outbid all the other guys. Let's suppose that your bank would have to pay the depositor a 2% rate of return to motivate him to put money into your bank vault rather than spending it or depositing it in some other guy's bank vault. That means that this bank must charge its customers, that is the borrowers, at least 2% just to cover the cost of inventory. The bank's cost of inventory can be affected by the household's desire to spend money and by the policies of the Federal Reserve. Now, we will talk about the policies of the Federal Reserve again in Module 10, the module on money, banking, and monetary policy. Now, this term, cost of inventory, you will only hear that in this class. I use that term to emphasize the fact that a bank is a middleman who needs an inventory to do its job. In the financial community, however, this is known as the cost of funds. Every business has expenses, usually of many kinds. The pricing strategies of a business must be that it covers its business expenses and provides the owner with a profit. We'll let this next block represent what the bank must charge after it covers its cost of inventory to cover its business expenses and provide the owners with a profit. We'll call this block the cost of operations. So in a way, this bank is operating very much like a typical retail store. It buys its inventory wholesale, in this case 2%, and sells its inventory at retail, in this case 3%. So now that we are comparing a bank to a retail store, let's consider another cost of doing business that is analogous to a very important cost faced by the typical retail store. And the retail store will cover this cost by passing it on to the customer by raising the price of the good. The cost that I'm referring to here is the cost of shoplifting. Let's say that shoplifting is 1% of sales. That means that the store would add 1% to the price of the product in order to pass the cost of shoplifting on to the consumer. Now the store is charging 4. 2 to cover the cost of inventory, 1 to cover its business expenses and provide a profit to the owners, and 1 to cover the cost of shoplifting. But shoplifting per se isn't really a problem for a bank. From time to time, there might be some pilfering by the tellers, or perhaps a bank robbery, but the bank has insurance for that kind of stuff. The cost for the bank, that is analogous to the cost of shoplifting for the retail store, is when the borrower doesn't pay the money back. When the borrower doesn't pay the money back, it's known as defaulting on a loan, and a bank must cover the cost of default just as a retail store covers the cost of shoplifting by passing this on to the customer. For a retail store, it is illegal as well as impractical to discriminate among customers in deciding how much to add to the price of a good to cover the cost of shoplifting. It has to pass the same amount on to every customer equally. But this is not the case for a bank or any other depository institution. A bank is able to discriminate among borrowers in deciding how much to add onto the interest rate that they are charged to cover the cost of default. Now, it is illegal to discriminate among borrowers based upon their age, race, or sex, but it is totally legal and practical to discriminate among borrowers based upon the lender's perception of the risk of losing money by dealing with a particular borrower. A bank wants to charge the borrower the lowest rate possible. It must do so because financial markets are highly competitive. Hypothetically, a bank that charges 1/8% more than all the other banks will get no business whatsoever. Borrowers will go to some other bank that's charging less. But a bank that is charging 1/8% less than everybody else will get all of the business. So a bank wants to charge the lowest rate that it can, but it must be consistent with protecting itself from the risk of losing money by lending to a particular borrower. Therefore, a borrower that is considered by the lender to be of low risk will only get a little added on in order to cover the cost of default. A borrower that is considered to be of high risk will get a lot more added on. The amount that is added to cover the cost of default is determined by the bank's perception of the risk of losing money by dealing with a particular borrower. But what is it that determines this perception? That is, what is it that determines the borrower's risk profile? It is the 5 C's of credit. The 5 C's of credit is a list of criteria that lenders use to determine the riskiness of a borrower. It's called the 5 C's because each item in the list starts with a C, although the language has to be tortured a little bit in order to make it fit. You'll see why in just a second. Let's examine each criteria in this list in order to understand the factors that a lender would use to assess your risk profile and therefore determine the size of the cost of default box for you or some other borrower and for a particular type of loan. Here's the list. As you can see, each item starts with a C, although it's not obvious on the surface what each would mean. Let's briefly examine each of these just to get a little insight on how a lender assesses a borrower's risk profile. But a course in personal finance would give you a much more complete analysis of each of these criteria. The first criteria in this list, capital, refers to your wealth, the value of your assets minus the value of your liabilities. In other words, how rich you are. Obviously, the richer you are, the more capable you are of repaying your loan because you could sell off assets in an emergency, and therefore the less risky the borrower is perceived to be. The second item on the list, capacity, refers to your income. Obviously, a borrower with a higher income has a greater ability to repay the loan and therefore will be perceived as less risky and will therefore be charged a lower cost of default box. Now, when you consider the first two criteria, capital and capacity, this means that a richer person with a high income will be charged a lower cost of default box than a poor person with a lower income. Does this mean that the poor person with a lower income will be charged a higher interest rate? The answer is yes, everything else being equal. Is this fair? This issue is a moot point. Fairness is not an issue when it comes to the lender protecting himself from risky borrowers. The third item on this list, character, refers to the priority the borrower places on repaying his loan. Now, this is indicated by the FICO scores that are reported by the 3 credit bureaus, Equifax, TransUnion, and Experian. It is, in essence, your credit history. A person with a squeaky clean credit history will be perceived as a lower risk and therefore will be charged a lower cost of default box than a more risky person with a lower FICO score. The fourth item, collateral, refers to the value of the asset you pledge to secure the loan and the rate at which it will depreciate. If the borrower defaults on a loan, the lender can get his money back by selling off the asset that the borrower pledged as collateral. The more valuable the asset and the better it retains its value over time, the less risky the loan and the lower, therefore, will be the cost of default box. The final item on the list, conditions refers to the sensitivity of your employment and your income to fluctuations in the level of economic activity. In other words, how sensitive will your income be to a change in economic conditions? For example, would you lose your income, or would your income go down if the economy slowed down or went into a recession? Or would your income be stable? Obviously, the more sensitive your income, the more it would fluctuate with the economic conditions, the more risky the borrower would be perceived, and therefore the higher would be the cost of default box. A borrower with a more reliable, more stable income would be perceived as less risky, and therefore would be charged a lower cost of default box. A worker who received a regular salary, for example, say from the government, would be perceived as having a reliable and stable income. However, a salesman who earns his income through commission would be much more sensitive to fluctuations in the economy and the level of total spending, and would therefore be perceived as more risky. If you and I walked into a loan officer's office at a bank and applied for the same loan, whether it's for a house, a car, a boat, or maybe a trip to Hawaii, it's my guess that I would get a lower interest rate than you. That's because I would be charged a lower cost of default box. For one reason, I'm richer than you. Now, this is only my guess. I may or may not be. But I'm guessing I am because I've lived a lot longer than you, and I've had an opportunity over these many, many years to acquire lots of assets. And therefore, because I have more assets that I could sell off in an emergency in order to pay the loan off, then I am considered a lower risk. Another reason is that I have a higher income than you. Now, this is only my guess. Now, I'm basing this upon the fact that I've been in the workforce for many, many years, and virtually every year I've received a raise of some kind, sometimes more, sometimes less. Now, you have not had this opportunity. You haven't worked as many years, and you haven't received these raises year after year. And so that's why I'm guessing my income is higher. And of course, a guy with a higher income is perceived to be a lower risk and will be charged a lower cost of default box. Thirdly, I have a squeaky clean credit rating. Now, you may have one too, but what is certain that my credit history is much longer than yours. And so it is very likely that my FICO score is higher than yours, and therefore I will be charged a lower cost of default box. Fourthly, I have an array of assets that I can use as collateral. I have a house, I have a car, I have some financial assets. It is likely that you have not had the time in your life to accumulate these assets, and therefore you have less valuable collateral to secure the loan than I do. Finally, I am a tenured professor. That means I can't be fired. Actually, I can, but I'd have to try real hard. In other words, my income is going to be stable and reliable and not affected by fluctuations in the level of economic activity. They can't fire me on some capricious whim. So the lenders are going to know that my income will be stable, and thus I will be perceived as low risk. Here's what my loan will look like. Notice I have a 1% cost of default box. Here's what your loan looks like. Your cost of default box is higher because you are perceived to be a greater risk. As a result, you're going to be paying 8% on this loan. I'm going to be paying 4%. The cost of default box accounts for two interesting aspects of the interest rate. First, the cost of default box explains why one person would pay a higher rate than another person for the same loan. Now, we just reviewed that reason. But it also explains why we use the term rates, plural, rather than just rate. That's because a particular borrower would pay one rate for a home mortgage, another rate for a car loan, and yet another for a trip to Hawaii. The rate that one pays will depend, among other things, on the nature of the collateral that is used to secure the loan. The best form of collateral, from the perspective of the lender, would be a house. That's because the value of a house will tend to rise over time. Suppose you wanted to buy a house costing, let's say, $400,000. The bank wouldn't lend you $400,000 to buy this house, but it might lend you $350,000 if you use the house as collateral. Let's suppose that you defaulted on your absolute first payment. The bank would then lose that $350,000 that you owed it, but it would have that $400,000 house that you used for collateral to sell and get its money back that way. As you can see, this is not going to be very risky for the bank because the value of the collateral is greater than the value of the loan. You default on the loan, they sell off the collateral, get their money back, everything is cool. Because it's not very risky, they are not likely to charge you a very high cost of default box. But what if you defaulted 10 years down the road? Let's say that in that time you paid off $100,000 of the principal. The bank would now lose only $250,000. But by this time, the price of the house might have gone up to $500,000. Now, the value of the collateral exceeds the amount that the bank stands to lose by an even greater amount, meaning the bank faces even less of a risk of losing money. So, in the case of a home mortgage, where you use the house as collateral, and because the value of the house will tend to rise over time, the bank will not face much of a risk of losing money. It's still entirely possible, as we saw in the housing crisis back in 2008. But in general, because the risk of losing money is so low on such a loan, the cost of default box will be very small. But what about a car loan? A car is less secure as collateral because, unlike a house, which tends to increase in value over time, a car will depreciate in value over time. And secondly, if the bank attempts to repossess a car that's used for collateral, it may not be able to find it. For that reason, a home mortgage will have a relatively low cost of default box, and a car loan will have a higher cost of default box. And therefore, the interest rate on a home mortgage will be lower than that of a car loan. In the case of a personal signature loan, the cost of default box will be very high. And that's because no collateral is used to secure the loan whatsoever. There is one more cost that the lender must cover in deciding what interest rate to charge a borrower. That is the cost of inflation. Inflation is a rising general level of prices. When the price level goes up, the purchasing power value, that would be the real value of the dollar, goes down. So, if there is inflation while the borrower is holding the lender's money, the borrower will then be paying back less valuable dollars to the lender. The purchasing power value, that is the real value of the dollars that the borrower pays back, is less than it was when he borrowed the money. The lender is aware of this phenomenon and therefore protects himself from inflation by adding on a buffer and thereby letting inflation eat away at this new block. The size of this buffer will be determined by what the lender thinks inflation will be while the borrower is holding his money. Let's suppose that the lender believes that inflation will be 3%. When we add that 3% block to the others, the total interest rate that the lender will charge the borrower will now be 7%. If the lender thinks inflation will be higher, he'll add more. If he thinks inflation will be lower, he'll add less. Remember, he's got to remain competitive with all the other lenders. Therefore, over time, the interest rate will fluctuate directly with the lender's expectations of inflation. If lenders believe inflation will be higher, they will add more, causing the interest rate they charge to go up. If they believe inflation will be lower, just the opposite will happen. Before we leave this issue, we need to do one more thing. We need to distinguish the nominal interest rate from the real interest rate. The term nominal, as you already know from our discussion of the income effect when we were doing supply and demand analysis, means in money terms. Nominal, in money terms. For example, my nominal income is $100 a week. In economics, the real value of something refers to its use value. What do we use our income for? Well, we use it to purchase things. Therefore, the real value of your income is the amount of things that we can purchase with it. The nominal interest rate refers to the amount of money that the borrower will pay to the lender for services rendered. Remember, the lender is providing a borrower with a service, allowing him to have something now rather than making him wait until he saves up enough cash to buy it. The nominal interest rate refers to the amount of money that the borrower will pay to the lender for that service. The real interest rate refers to the amount of purchasing power that the borrower will pay to the lender for services rendered. Suppose you wanted to borrow $1,000 from me. Of course, I would expect to be rewarded for this service, so I think to myself, let's see, I'll let you use my money if I can get a 5% rate of return. That seems fair. But what will be my increase in purchasing power if there's a 4% rate of inflation while you're holding my money? If inflation eats away at 4% of the purchasing power of my return, that will leave me with a 1% increase in purchasing power. Now that's no good. I wanted 5%. I charge you a 5% nominal rate, but the real rate that I receive, and that's the more important one, is only 1%. So I'll just add that 4% on top of the 5% and let inflation eat away at that 4% block. That'll leave me with the 5% that I wanted. So that means that I'll have to charge you a 9% nominal rate in order for me to get my 5% real rate. As you can see, the relationship between the real interest rate and the nominal interest rate a lender will charge to protect himself from inflation can be expressed as the real interest rate that the lender wants to receive plus the inflation rate that the lender anticipates is equal to the nominal interest rate that the lender must charge. The idea, of course, is to use that gray cost of inflation box as a buffer. Then, if inflation, shown here as shaded in red, turns out to be exactly what the lender projected, inflation will eat away at the 4% buffer and leave the lender with the 5% real rate of return that he wanted in the first place. But what if inflation wasn't exactly what the lender anticipated? Suppose, for example, that inflation actually turned out to be, let's say, 7% while the borrower was holding his money. If that were the case, then inflation would eat away at more of the purchasing power that the borrower paid him, leaving the lender with only a 2% real rate of return. That is a 2% increase in his purchasing power. As you can see, the lender does not like inflation that was greater than what he anticipated. The lender did not protect himself from this unanticipated inflation. Or suppose that inflation turned out to be less than what the lender anticipated. Suppose inflation was only 1%. Because inflation is eating away at less of the purchasing power than what the lender anticipated, the lender now receives an 8% real interest rate. We can now state the formula for computing the real interest rate. The nominal interest rate that the lender charges minus the actual inflation rate, not the inflation rate that the lender anticipated, but the actual inflation rate, is equal to the real interest rate that the lender actually receives. Here it is written out in a more familiar form. The real interest rate is equal to the nominal interest rate minus the actual inflation rate. The lender hates it when inflation is higher than he anticipated, but the borrower loves it because now he's paying the lender less purchasing power than he had originally agreed upon. Would you make the following deal with me? Lend me $1,000 today, and I'll pay you back in 25 years, with no interest, mind you, your $1,000. Heck no, that would be a bad deal for you. Why? Not only because I'm not paying you interest, but you understand that during that 25 years, there may be tremendous amounts of inflation. Who knows? Maybe in 25 years, that $1,000 won't even be enough purchasing power to buy you a #1 value meal at Burger King. I, the borrower, am loving inflation. Why? Because I'm borrowing enough money from you to, I don't know, what can you do with $1,000? Take a nice trip someplace, I suppose. But although I'm paying you back your $1,000, I'm just paying you back enough purchasing power to buy a hamburger. The bottom line is that the lender hates inflation because it eats into the purchasing power value of his returns. But the borrower loves inflation because now he's required to pay back less purchasing power than he had anticipated. In summary, at any moment in time, there will be an array of interest rates. One reason is that lenders will perceive different borrowers to be of different risks. This is why, for example, I'm likely to be charged a lower interest rate than you for the same loan. Another reason is that the interest rate that a lender charges will depend upon the nature of the collateral that the borrower pledges to secure the loan. This explains why the interest charged on a home mortgage would be less than that for a car loan. Both of these variables affect the cost of default block that the lender charges. Additionally, interest rates will change over time, and they are affected by the lender's expectations of inflation. Thirdly, the relationship between real and nominal interest rates can be expressed as the real interest rate is equal to the nominal interest rate minus the actual inflation rate. In the next video, and the third of the 3 concerning the financial sector, we will connect the box that we call the money market to the rest of the circular flow.